Commercial investment properties are full of risk and minimal returns. Wrong. Here are the biggest myths around investing in commercial real estate. All investments come with risk. That's just the nature of it. If it were easy, everyone would do it. But when it comes down to commercial properties, investors often think there's too much risk involved, which is usually a big misconception. Time and time again, we see this so-called risk of commercial property investment blown out of proportion. Hey everyone, Andy Trin here for another video designed to help you become a better property investor. In today's video, I'm separating fact from fiction with the biggest myths that stop investors from buying commercial properties. In reality, a lot of these myths are created by those who have little to no experience in dealing with commercial assets like this. So let's lay down what you should believe and what's better left in the dust. Firstly, it's important to understand why people usually avoid buying into commercial property market and instead jump into residential. Myth number 1. The duration of vacancies is long. This is probably the biggest reason of all and the biggest myth. In reality, vacancies can be drawn out for any kind of poor quality asset, not just commercial ones. Basically, it all comes down to the investor needing to carefully assess all aspects of the property they're looking into, including the location, the building itself, rent levels, and the current market climate. This level of due diligence will ensure you don't end up with a commercial property that does seem to fulfill this myth. If you opt for a property in a location where there's high demand but a lower supply, you'll quickly fill your space. Likewise, if you choose a location where this is the opposite case, then obviously vacancy periods will be longer. In most cases, leases include minimum vacate notices in the contract itself. This means that the tenant needs to give the investor or landlord 3 to 12 months notice before leaving the property. If vacancy rates scare you, this is often a good peace of mind. Myth number 2. Minimal capital growth. If you're looking for a myth that's further from the truth, this is the one. Some commercial properties can massively exceed value over a good period of time. It's just all about finding a property that will boost your chances of getting this level of growth. When it comes to commercial properties, capital growth all depends on the same factors that residential growth does. Whether a location is good, if the demand is where you need it to be, infrastructural improvements, growth of population, a balanced vacancy rate, positive renovation potential, declining interest rates, decreasing unemployment rates, and gentrification. So as long as these factors are around for residential, the same goes for commercial. Okay, next up, myth number 3. There is a lack of value-add opportunities. People often assume there's no way to draw out long-lasting value in a commercial property. This simply isn't true. If you know how to go about it, there are plenty of ways to improve and update a commercial space and continue to maximizing your profits. But because a majority of your success here depends on the rental income you're able to reel in, you'll need to find a property that's not getting its maximum rental income just yet, so you can level up your equity gains. Further on from that, you can also dive into subdividing if the property type suits. Warehouses are a great example here and are in a hot demand too. But beyond space, there are other value adds you can enjoy from a commercial property investment, including extending lease durations, rezoning, redeveloping, and renovating. Myth number 4. Only the wealthy can do it. It's all about saving what you need and showing a bank you're worthy of funding. While it may take a bit longer for you to get the finance, you need to jump into the market. You may end up with equally, if not more, rewarding opportunities than in residential investments. As a general rule of thumb, you'll need around $100,000 for a deposit as a starting point. Myth number 5. Commercial investments are time-consuming. We often hear that investing in commercial properties is more time-consuming and complex than residential. While that's not untrue, your main focus should always be to locate the best opportunities so they don't wind you up with a dud investment. So yes, that does take more time. However, there are plenty of professionals and third-party services out there who have the expertise to handle all of this for you, eliminating any risk that the process will be endlessly drawn out. What it all comes down to is whether you do your research and due diligence from the very beginning. If you don't look into these 5 factors, you won't know whether a commercial property really is a good opportunity, or if it will only make you further believe that residential market is a better fit. I hope you found this video helpful. Don't forget to hit the subscribe and follow our YouTube channel for more useful tips like this and to keep up to date with our latest content. Until next time.